I combined price action strategy pin bar and two indicators to make this money. Towards the end of this video, I will explain in details. Please for now, like, follow and share as we continue. Thank you. Candlestick Trading Bible deeply explains everything about pin bar trading strategy. In this video, we will start with reading it together till its end. Then you will now see my analysis. Thank you. Today we continue the reading of this Candlestick Trading Bible with the pin bar candlestick pattern strategy. The pin bar candlestick is one of the most famous Japanese candlesticks. It is widely used by price action traders to determine reversal points in the market. In this section, you will learn in detail how to identify potential pin bar signals and the conditions needed for high probability setups. A pin bar is a chart candlestick. It is characterized by a very long tail that shows rejection and indicates that the market will move in the opposite direction. The area between the open and close is called the real body. Typically, all pin bars have a very small real body and a long shadow. A bullish pin bar is known for its low wicks, and the bearish one is characterized by long upper wicks. The color of the candlestick is not quite important. However, bullish candles with white real body are more powerful than candles with a real black body. Please, I want you to replace this white with green and the red with and the black with red. So, a bullish pin bar is known for its low wicks, and the bearish one is characterized by long upper wicks. The color of the candlestick is not quite important. However, also a bullish candles with green real body are more powerful than candles with a real red body. On the other hand, a bearish pin bar with red real bodies are more important than the ones with green real bodies. See below. Can you see the bullish pin bar? In your chart, you see these as green, and the bearish one you see as red. How to identify pin bar candlestick setups? To be honest, quality price action setups don't exist in the market, because you will see that sometimes you can find a high probability setup. You feel very excited about it and you take your trade with confidence. But at the end, you will be frustrated because the signal fails for unknown reasons. That happens a couple of times because the market doesn't move due to pin bar formation. What moves the market is the law of supply and demand. Let me give you an example. If you identify a quality pin bar candle near a support key level in an uptrend market, this is a powerful buying signal to take. You shouldn't ignore it. But if the amount of money that buyers put in this trade is less than the amount of money that sellers risk in the same trade, the markets will not go in your predicted direction. If the signal fails, it doesn't mean that your analysis is wrong or pin bars don't work. It's just because the market don't validate your decision. Therefore, you accept your loss and you look for another opportunity. You may ask yourself, why should we look for quality pin bar setups if the market doesn't respect them? As you know, trading is a game of probabilities. There is no certainty. This is why you should evaluate your pin bar setups from multiple angles, and the fact that you are looking for quality setups means that you are trying to put the probabilities of success in your favor, which is the right mindset of successful traders. To determine whether or not a pin bar is worth trading, this price action signal should respect the following criteria. The pin bar formed in line with the direction of the market is more powerful than the one which is formed against the trend. If you can identify a clear trend, that means that you know who is in control of the market. The formation of this candlestick pattern with trend makes it so effective. See the chart below. As you can see in the chart above, bullish pin bars that were formed in line with the uptrend work, and they should be taken into consideration. But the bearish ones that were formed against the trend should be ignored. The anatomy of a pin bar is more important as well. As you can see in the chart above, bullish pin bars that were formed in line with the uptrend work, and they should be taken into consideration. But the bearish ones that were formed against the trend should be ignored. The anatomy of a pin bar is important as well. You have to make sure that the candlestick is a pin bar by looking at the distance between the real body and the tail. Pin bars with longer tails are more powerful. The psychology behind pin bar candle formation. Pin bars are formed when prices are rejected. This rejection doesn't indicate a reversal signal because this price action setup can form everywhere in your chart. The most important area to watch when trading pin bars are major key levels such as support and resistance, supply and demand zones, and moving averages. The formation of this candlestick chart pattern in these levels give a clear idea about what happens in the market. If the rejection was near a support level, for example, this is an obvious indication that the bulls are more powerful and they are willing to push the market to go upwards. Let's see the chart below. If the formation of this candlestick occurs near a resistance level, it indicates that the bears reject prices and prevent the bulls from breaking this level. So, this means that sellers are willing to push the market downward. See the chart below. If you understand the psychology behind this price action pattern formation, you will be able to predict what is likely to happen in the future, and you will make good trades based on high probability pin bar signals. Trading the pin bar candlestick with the trend. If you're a beginner trader, I highly recommend you to stick with the trend because pin bars that occur in trending market offer good trading opportunities with high risk to reward ratio. When you master trading with a trend, you can then move to trade range bound markets or even counter trends. This strategy is simple. You start by identifying a clear uptrend or downtrend, and you wait for a pin bar to occur after a pullback to support or resistance level. The figure below shows how this price action signal works if it is traded with a trend. As you can see, the price was rejected from the resistance level, which indicates that the bears are still in charge of the downtrend. The formation of pin bar candlestick. The formation of the pin bar indicates the end of the retracement move and the beginning of the impulsive move at the resistance level in line with the downtrend. This is a high quality setup because All the following criteria are respected. Number 1. The pin bar is well formed and it is in line with the direction of the market. The rejection occurred in a major resistance level, which represents a hot point in the market. The risk to reward ratio is good and is worth trading. Sometimes, even if the market is trending, we can't draw support and resistance levels because prices move in a certain way which we can't spot static key levels. If you're in this situation, you can use the 21 moving average, which will act as a dynamic support in an uptrend market and a dynamic resistance in a downtrend market. See illustration below. As you can see in the chart above, the market was trending down. Using the 21 moving averages help us to identify dynamic resistance levels and high probability pin bar setups. See another chart below. The 4-hour chart above illustrates how the 21 moving average could help us find key points in the market. When prices approach the moving average, the buying pressure takes place in the market and the price goes up. The pin bar signal is clear on the chart because the trend is bullish. The price action setup has a bullish anatomy as well. The rejection from the 21 moving average is a confirmation signal to buy the market. This is trading tactics. When we identify the trend, uptrend or downtrend, and the levels, support and resistance, and we find a pin bar near these levels in line with the direction of the trend, the second step is to know how to enter the market based on the candlestick pattern. According to my experience, there are different entry options when it comes to trading pin bars. It all depends on the candle anatomy, the market condition, and your money management strategy. Number 1, the aggressive entry option. This method consists of entering the market immediately after the pin bar closes without waiting for a confirmation. This strategy will help you catch the move from the beginning because sometimes the price goes higher after the close of the pin bar, and if you are not in the market, the trade will leave without you. See the example below. The chart above shows how an aggressive entry could help you to execute your trades in the right time without being left by the market. As you see, we took this trade because we had 3 important elements. The trend, the market was trending down. In this case, we look for selling opportunities. The level. In this chart, we had a support level that becomes resistance. The signal, a clear pin bar was formed after the retracement back to the resistance level. When you have these 3 elements in the market, you just place your trade after the close of the pin bar and you stop loss above the long tail. Your profit target will be the next support level in the case of a downtrend. These 3 elements are quite enough for you to find high probability entries in the market. The conservative entry option. This strategy consists of entering the market after 50% of range bar retracement. This strategy sometimes will work and it gives you more than 5-to-1 risk-reward ratio, and sometimes the market will leave without you. See the illustration below. The illustration above gives us an idea about the power of conservative entries. As you can see, this entry method helps us decrease our risk and increase our rewards. The trade above has more than 5-to-1 risk to reward ratio. One trade like this every month is quite enough to generate a decent income. see another chart below. One of the drawbacks of this entry option is that the market sometimes doesn't retrace 50% of the range bar, which will make you feel frustrated because the market will move to the profit target without you. There's no wrong or right entry option. They both work great. But with screen time and experience, you'll be able to decide whether to trade aggressively or conservatively. Trading pin bars with confluence. Confluence happen when many technical indicators generate the same signal. This trading concept is used by price action traders to filter their entry points and spot high probability signals in the market. It doesn't matter if you're a beginner or an advanced trader. Trading with confluence is a must because it will help you focus on quality setups rather than quantity, and it will enhance tremendously your trading performance. Confluence means combination or conjunction. It is a situation in which two or more things join or come together. For example, if we are looking for a pin bar signal, we need to find other factors of confluence to confirm our entry. We are not going to take any pin bar that we find on our chart. Factors of confluence. The trend. This is one of the most important factors of confluence. This is the first thing that most successful traders look for on their chart. You can't trade any setup without identifying if it is in line with the direction of the market or not. A bearish pin bar in a downtrend is more powerful signal than the one in a range-bound market. Support and resistance levels and supply and demand areas. These major levels have a significant importance in the market because all big participants watch these specific areas. Moving averages. I personally use the 8 and 21 moving average. These technical trading tools act as dynamic support and resistance, and it is a very important factor of confluence in trading markets. Fibonacci retracement tool. I use the 61 and 50 Fibonacci retracement to find the most powerful areas in the market. Trend lines. Drawing these lines to your chart gives us an idea about the market direction and help us find the most important reversal points in the market. When you are analyzing your chart, you are not obligated to find all these levels to determine whether the trade is valid or not. If you find just one or two factors of confluence that come up together with a good pin bar setup, this is quite enough to make a profitable trade. For example, an obvious pin bar signal near support or resistance level in line with the direction of the market. Can you see? In the example above, we have a high probability setup with 4 factors of confluence. Number 1, the trend. The market is trending up, which means that we have to follow the trend and look for a buying opportunity. Number 2, the level. The support level is an important key level in the market. As you can see, the price broke out of the resistance level that becomes support and pulled back to it. The signal. The formation of bullish pin bar after the retracement back to the resistance level that becomes support. Another signal, the rejection of the pin bar from the support level and the 21 moving average that act as a dynamic support level. All these factors work together to give us a powerful trading signal to buy the market. See another example. The example shows four confluent levels that indicate a powerful trading signal. The first factor is the bullish trend. The second one is the resistance level that becomes support. The third one is the 21 moving average that acts as a dynamic support level. And the last factor is the pin bar formation near these levels, in line with the bullish trend. If you adopt this trading concept, you will completely change the way you perceive the market, and you will start trading like a sniper by waiting for the best trading setup to come to you instead of trying hard to make trades happen. I'll give you some trading examples to help you understand how to trade the pin bar candlestick pattern with the trend, and how to use the confluence concept to confirm your entries. This is the NZD-USD chart. As you can see, the market is trending down. This is the first information that we gather from this chart. After the breakout of the support level that becomes resistance, the price retraced back to this level and formed a pin bar candlestick pattern. The formation of the pin bar near the resistance level indicates that the retracement move is over and the beginning of an impulsive move is likely to happen. When we put the 21 moving average and the Fibonacci retracement on the chart, we see that the pin bar is rejected from these levels, which indicates that this level is very important and sellers are willing to push the market lower. Here in this example, we have solid reasons to sell the market. The first reason is the downtrend. The second reason is the formation of the pin bar near the resistance level, which indicates the end of the pullback and the beginning of a new move downward. The third reason is the rejection of the pin bar from the resistance level and from the 21 moving average. The last reason is the pin bar rejection from the 50 Fibonacci retracement level, which is considered to be one of the most powerful key levels in the market. Look at the chart and see what happened next. As you can see in the chart above, our analysis was right because it was based on solid reasons to enter the market. This is the method that I want you to learn to be able to trade the market successfully. Look at another chart below. The chart above shows two important buying opportunities. The market was trending up. The formation of the first pin bar after the retracement back to the support level was a high probability entry. What confirms our entry is the rejection from the 21 moving average and the 50% Fibonacci retracement. The same thing happens with the second pin bar that allows us to enter the market again and make more profits. Trading pin bars in range-bound markets. We can say that a market is ranging when prices don't make any higher high and higher low and start trending horizontally between a defined level of support and definable level of resistance. Once I see that the market changes its behavior, I have to change my tactics and adopt a trading strategy that fits this new market condition. To confirm a ranging market, I have to look for at least two touches of support level and two touches of resistance level. And once I have identified the range, then it becomes very simple to trade it by going To confirm a ranging market, I have to look for at least 2 touches of support level and 2 touches of resistance level. And once I have identified the range, then it becomes very simple to trade it by going long when prices reach the support level and going short when prices approach the resistance level. See below an example of a range-bound market. As you see, a price approach key support or resistance level. We have an opportunity to buy or sell the market. We need just to wait for a clear price action setup such as a pin bar candlestick. Look at illustration below. The illustration above shows us 3 trading opportunities. Let me explain to you how you can trade them successfully. Number 1. The first one is a pin bar rejected from the support level. You can place a buy order after the pin bar closes, or you wait for the market to touch the 50% of the pin bar range. Your stop loss should be placed above the support level, and your profit target must be placed near the resistance level. The risk-reward of this trade is very attractive. The second trading opportunity occurs near the support level. You place a buy order after the close of the pin bar, and your stop loss should be below the support level. Your profit target is the next resistance level. The third setup is an obvious buying opportunity. As you can see, the market was rejected from the support level and formed a pin bar to inform us that buyers are still there and the market is likely to bounce from the support level. Trading from major key support and resistance level is the easiest way to make money trading range-bound markets. Do not ever try to trade any setup if it's not strongly rejected from these areas. The second strategy is about trading in the direction of the breakouts of major key levels or waiting for the prices to retrace back to the breakout point, and then you go long or you go short the market, or you short the market. The figure above illustrates a range-bound market. The price broke out of the support level and retraces back to the point of the breakout, and the formation of an obvious pin bar indicates a high probability signal to short the market. This is how professional traders trade ranging market based on this price action signal. How to confirm pin bar signals using technical indicators. Using technical indicators to confirm entries will increase your probability of the trade being profitable. I'm not telling you that you have to focus on indicators to generate signals, no, because this will never work for you. But if you can combine your price action strategies with the right indicators, you will be able to filter your signals and trade the best setups. One of the indicators that I use to confirm my entries when I examine a range-bound market is the Bollinger Band indicator. This technical trading tool was developed by John Bollinger to measure a market volatility. The strategy is very simple. We will combine horizontal support and resistance with the upper and lower Bollinger Band force breakouts. If the prices are rejected from major key levels and from the bands, this is a confirmation that the market will bounce from these levels. See an example below. If you look at the chart above, you will notice how the Bollinger Bands act as a dynamic support and resistance. When the market approaches the upper or the lower bands, prices bounce strongly. So if we see that a pin bar is rejected from a horizontal key level and from bands, this is a clear confirmation to buy or sell the market. This confirmation strategy is very simple, and it will help you decide whether to take a trade or ignore it, because trading is all about emotions, and sometimes you will spot a nice pin bar signal in a range bound market, but you will find it difficult to make a decision. What you have to do in this case is simple. Just put your Bollinger Band on your chart, and if you see that the signal is rejected from horizontal levels and from the bands, don't overthink about what you should do next. Just execute your trade. Place your stop loss and your profit target. Then stay away and let the market do the work for you. See another illustration below. The daily chart above shows us how this indicator could help us execute our trades with confidence. The false breakout of the resistance level that was made by the pin bar was a powerful signal to short the market. The trade was confirmed by the false breakout of the upper band as well. Remember that this technical indicator is used just as a confirmation tool in range-bound markets. Don't use it to generate signals. Use it always in combination with horizontal key levels, and you will see how this strategy will affect positively your trading account. In conclusion, I recommend you to practice these strategies as much as you can before you open and fund your trading account. Here is the detailed analysis of how I took this trade. Looking at the chart you see before you, the first thing I put into consideration is the price action, the bullish pin bar. Once it showed up in the screen, I already know that the trade is bullish. I also needed a confirmation, and then I used the two moving average, the brown line and the green line you see there. The brown line is the 200 moving average, while the green line is the 21 moving average. The two, I was waiting for the green one to cross over the brown one, which is 21 moving average crossing 200 moving average. It confirms a bullish trend. So as the price action showed up, the bullish pin bar, and as well the moving averages, is already a pure buy trade. Last indicator I used here is the RSI. RSI can be used as overbought, oversold, whenever it's at 70 or 30, and also can be used as a momentum indicator. In this trade, I used it as a momentum indicator, and in momentum indicator you only consider the level 50. Yes, whenever a pattern, whenever a trade, a market clearly crosses that level 50 up, it is a pure bullish signal. If it's down, it's a pure bearish or sell signal. So that's just it. So in this trade, as you can see, at level 50, the trend reverses and is bullish, and it clearly shows it's bullish. I had to enter. Every other thing worked out fine. Yes, but we should also be very, very careful to be sure that it's at that level 50. The direction is already defined, so it will not be that you are entering on a retest. You should be careful. Yes, and then a very important thing I want to teach us about RSI in combination with Bollinger Band. The Bollinger Band you see above, I don't consider it in this trade. It's a very, very powerful strategy. please do like and subscribe to this channel so that you can get to see it. Yes, and then finally I want to show us the settings I use in these indicators. Here is the settings I used in this trade. You see, for the moving averages, can you see moving average period 200? So this is for the period 200. Method exponential apply to close, and that's it. Time frame, all time frames, that's it. And that of period 21, can you see that? Period 21, method exponential apply to close. So that's it, all time frame. You can change color here, as you can see. And then for the RSI, yes, here you can just use 50. You can type in your numbers here. Yes, you can just use 50, maybe 70 and 30. That's all.
Let the period be 30, please, not 7.
That's how the settings of the trade is. Thank you very much. Please do not forget to subscribe. Do not forget to like. It's necessary so that I can follow up other things and become a very powerful trader and begin to make money. You can make from $5, from $10 to hundreds of thousands of dollars. So thank you.